But we begin with our expert panel and 3 things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Andrew Bary, Elizabeth O'Brien, and Al Root. Andrew, the stock market, we got that rate cut on Wednesday. The market dipped a little bit later in the day. Raging gains on Thursday and kind of flattish on Friday. What is the market trying to tell us, if anything? Is it investor indecision? Was the rate cut priced in? What are you seeing?
I mean, some of it might have been priced in, but it was a mild surprise about getting a half-point cut in rates. And Fed Chairman Powell talked about a recalibration of short-term rates, which means you're going to be more cuts likely to come. You could see short rates now, which are under 5, drop to maybe close to 4 later this year, and maybe 3% in 2025.
What about FedEx stock? FedEx got killed this past week. Is that a FedEx problem, or is that sign of a
Well, there were some company-specific issues, including, customers trading down to lower-price delivery options, but also it could be a cautious read on the economy. UPS, which is its competitor, also has been weak this year, so it's something to watch.
Yeah, FedEx, it's sort of a good news, bad news. Some of that trade down, industrial companies use a lot of those premium services. That demand is drying up. It sort of tells us stuff we already knew. Industrial economy stinks, but it really was unexpectedly bad for FedEx.
Andrew, gold hit another new high. Where's gold headed? How high is it headed?
Gold is above $2,600 an ounce today on Friday, and it's up about 25% this year. It's one of the better asset classes, better than the S&P 500, which is up around 20%. So it could be signaling some caution about the overall financial backdrop. You're seeing central banks buying gold, and also, there's some maybe concern about the U.S. budget deficit.
Too late to buy it here?
I don't think so. I think gold could be heading to 3,000.
Yeah, that makes me a little nervous, because gold thrives on panic. So what is everybody panicked about under the surface?
Al, Boeing. Boeing is in its 2nd week of a strike, okay? Furloughing workers, burning through cash. Will it have to issue stock?
I think definitively yes. Now, I think the strike is sort of the exclamation point on sort of their problems, but they've accumulated, almost $60 billion in debt. They still have some cash.
That sounds like a lot.
$60 billion in debt. Airbus has no net debt. They haven't generated a profit since 2018. So there is an equity raise coming. I think it's almost inevitable. And, they talk about defending their credit rating. So everything they say screams we're going to have to issue stock, which dilutes shareholders. And it's just it's part of the ongoing story of Boeing's slow decline and efforts to turn it around.
This is one of those things where I say, aha, a contrarian might be thinking about buying here, but also stepping in front of an ice cream truck, that's a contrarian move. I wouldn't recommend that. So is this a good contrarian move? Would you even consider buying the stock here?
Andrew and I debate this vigorously, and there is a lot to like about Boeing, right? There's only 2 aircraft makers. Right. They have billions of dollars in backlog that stretch out a decade, but there is still so many unknowns, like those equity raises. And they could generate $10 billion in free cash 2 or 3 years. That's pretty attractive, but you got to get there. So I'd at least like to see the strike
Debate
resolve.
Him vigorously, Andrew.
You know what? I tend to agree, but Boeing should be profitable. It's one of the great oligopolies in the world, but it's really stumbled badly. I'd prefer Airbus at these levels. It's the European competitor. It's got a better balance sheet. It's got a better narrow-body plane, and its profitability outlook's very good.
Is it building a durable competitive advantage amid all these troubles that Boeing is having?
Yeah, I think it does. It is the clear leader in the industry, but there's definitely room for 2 players, and because the airplane buyers around the world just need planes, and they need the planes from Boeing.
Okay, Elizabeth, our cover story argues that there is upside ahead for luxury goods sellers. Tell us about that.
That's right, Jack. Luxury shares have gotten hit hard, raising concerns about the economy. But while lower-income consumers have cut back on their spending, higher earners have not. So these companies have problems of their own making, including pricing missteps. Basically, in the wake of the pandemic, they set the prices too high on a lot of items, locking out those aspirational shoppers. But they will, of course, correct. And some of the attractive names are LVMH, which, of course, has a lot of popular brands, and
Louis Vuitton, Moet, Hennessy.
All right.
Booze and handbags,
exactly.
right? Am I missing anything?
Exactly. No, it's all good stuff. And also, that trades at about 20 times forward earnings, and Richemont, which sells jewelry.
Richemont. That's the
I hope I'm pronouncing it right. My high school French. I don't know.
fancy watches.
Yeah.
Andrew, what do you think about First of all, what do you think about luxury stocks here?
You know, I think luxury stocks are sold off hard. I mean, led by the industry leader, which is LVMH, which is controlled by the Arnault family. I think at these valuations, they're pretty attractive.
Nike swapped CEOs this week. Why?
They sure
and will
did.
that help the stock?
That's right. Nike CEO John Donahoe announced his retirement. He sort of stepped aside this past week. During his nearly 5-year tenure, they were saying the company sort of lost its cool. His changes stifled innovation. So Nike is bringing back a company veteran back from retirement, Elliott Hill, to sort of revitalize things, to fix the brand. And the shares, you know, shareholders seemed happy about it. Nike stock was up about 7% on the news.
They were going to go it on their own more, moving away a little bit from Foot Locker. I mean, what do you...
Yeah, they were de-emphasizing the stores and emphasizing online sales, which didn't work. I mean, competitors like Hoka and others, I mean, grab share. Nike's not been an innovator. Also, you've had like a former consultant running the company, like you had at Starbucks. Now you've got industry veterans running both Starbucks and Nike, which I think is probably good for both of them.
Can they eat some humble pie, go back to Foot Locker, get some of that Hoka space back? I guess we'll have to see. Thank you all.